Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Nuburu.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, to kick things off, I want you to just imagine a $2,000 commercially available drone taking out a multi-million-dollar armored vehicle.
Right, which is literally happening right now.
Exactly. It's happening in real time on battlefields all across the globe. But what if you could shoot down that drone, not with, an expensive missile, but literally with light?
Yeah, that is the exact premise we're analyzing today. We are looking at a fundamental corporate metamorphosis. We're tracking a company that is attempting a massive hypergrowth reactivation phase.
Because up until recently, this was a largely dormant industrial laser operation, right?
Right, very dormant. And suddenly, they're attempting to transform into this highly aggressive, vertically integrated defense and security platform.
It's a dramatic pivot. And, for you as an investor to understand if this is actually a viable wealth-building opportunity, we really need to analyze the mechanics behind it.
We do, because the velocity of this transition is, it's what demands our attention. We are evaluating a fundamental breakout in the underlying business mechanics here.
Backed by some pretty significant capital injections, which we'll get into.
Oh, absolutely. But to truly grasp the future trajectory of this stock, we really have to look at the baseline. And the historical baseline here is, it's incredibly modest.
Modest is putting it lightly.
Yeah. Prior to this pivot, the data showed an annual baseline revenue for this company of roughly $9,300.
Wait, let's just put that in perspective for a second. $9,300 for an entire year.
Literally, yes.
For a publicly traded entity, that is barely enough to cover the annual utility bill for, a small commercial office space, let alone fund the R&D of a bleeding-edge technology firm.
Right. It paints a very clear picture of a company that was essentially on life support.
Yeah, is effectively dormant. But then we hit the first quarter of 2026, and that marks a really decisive inflection point.
Yeah, the operational engine basically got turned on. And the fuel for this engine, the core intellectual property that makes this entire pivot possible, is their proprietary high-power blue laser technology.
Which is fascinating stuff, because when we talk about industrial lasers, it really helps to understand the underlying physics. Originally, this high-power blue laser IP wasn't for defense at all, right?
No, not at all. It was developed strictly for the manufacturing sector. Specifically, it was engineered for spatter-free copper welding and high-speed metal processing.
Which is huge for batteries.
Exactly. If you look at the macroeconomic trends, copper welding is this massive bottleneck in advanced battery manufacturing for electric vehicles.
Because traditional lasers just don't work well on copper, do they?
Right. Traditional infrared lasers, which have been, the industry standard for decades, they literally bounce right off copper. The metal acts like a mirror to that specific wavelength of light.
So it's just incredibly inefficient.
Inefficient and highly prone to defects. But blue laser light operates at a totally different wavelength. It's absorbed rapidly and efficiently by copper, which allows for these remarkably clean, precise, fast welds.
So, okay, they had this brilliant piece of fundamental technology. But rather than just fighting it out in the super crowded manufacturing supply chain, management looked at the geopolitical landscape and asked a very different question.
Yeah, they asked, how can the physical properties of this blue laser actually solve a critical defense problem?
And the answer they landed on is a counter-UAV market. They're taking this blue laser IP and engineering a portable directed energy laser dazzler to disable drones.
It's a strategic pivot that aligns perfectly with a glaring gap in modern military capabilities right now.
I'd say it's more than a gap. It's an analogy I like to use. It's like a struggling tech startup that suddenly finds massive product market fit in an entirely different industry.
That's exactly what it is. We've entered this era where asymmetrical warfare is just the default state of global conflict. The math of modern warfare is fundamentally broken.
Totally broken. You have state and non-state actors using cheap, mass-produced drones that cost, a few $1,000s?
Yeah, $2,000-3,000.
And they use those to disable or completely destroy highly sophisticated infrastructure and military assets worth millions.
Right. And the current defense mechanisms are entirely disproportionate.
Yeah.
You literally cannot maintain a viable defense posture if you're forced to fire a $2 million kinetic interceptor missile to shoot down a $2,000 drone.
You'll simply run out of money long before the enemy runs out of drone.
Precisely. That cost per kill ratio is totally unsustainable.
Yeah.
So the global defense apparatus is desperate for non-kinetic solutions. They need directed energy weapons.
Which is where this laser dazzler comes in. And what's interesting is it doesn't necessarily need to, like, burn a hole right through the drone's fuselage, right?
Right. No, instead, the high-power blue light is directed right at the drone's optical sensors. It overloads and basically blinds the camera systems.
So it effectively disables the drone's ability to navigate or target or gather intelligence.
Exactly. It neutralizes the threat without firing a single kinetic projectile.
And for you listening, the market for fixing that broken math is astronomical. They are tapping into a global total addressable market for counter-drone defenses that exceeds $20 billion.
$20 billion.
But, you know, a $20 billion TAM is just a number on a pitch deck, unless a company actually has the capital to physically build the hardware.
Oh, for sure. Moving from theoretical physics to a deployable defense product requires massive capital expenditure.
Which brings us to the financial engineering of this whole reactivation. Let's talk about the funding.
Right, so in late 2025 and early 2026, Nuburu secured a $25 million financing commitment from an entity known as YATIAPN.
Okay, $25 million.
Yeah, which provided them with $23.25 million in gross cash.
And for investors who might not be super familiar with the mechanics of microcap financing, entities like YATEPN often provide capital through specialized vehicles, right? Like private investments in public equity or convertible debt.
Yeah, this isn't your traditional bank lending. It is high-risk capital injected into microcaps to fund aggressive turnarounds or major expansions.
So the critical metric for you as an investor is how management actually allocates that specific influx of cash. Are they just using it to buy back stock?
No, and capital allocation is everything in this phase. The data shows they're not using this $23 million to just manage the balance sheet or artificially prop up the stock price. They're deploying it directly into vertical integration.
Tangible, United States-based manufacturing infrastructure.
Yes, and we're already seeing the initial output from that. In February 2026, they activated a production ramp for 40 high-power blue laser systems. That's a batch valued at approximately $850,000.
And then shortly after that, on March 31st, 2026, their recently acquired subsidiary, Lyocon, secured an initial deployment order specifically for that portable directed energy laser dazzler system.
Right, and that initial order is valued at roughly $250,000.
So that $250,000 order, that serves as commercial validation, doesn't it?
Absolutely. It shows a client is willing to actually pay for this specific, newly engineered counter-UAV application.
Okay, I understand the validation aspect, but I'm going to offer some healthy pushback here.
Oh.
Let's look at the math from a really critical perspective.
Okay, let's hear it.
We are talking about a $25 million cash injection. The output we are seeing right now is an $850,000 production run and a $250,000 order.
Right.
How many microcaps actually survive that initial cash burn without diluting their shareholders to zero? I mean, if I am investing in a company that just took on $25 million in financing, seeing basically $1 million in initial orders feels like a very precarious runway.
Yeah, that is a highly rational skepticism, honestly.
Yeah.
But it requires us to deeply understand the economics of defense manufacturing.
Okay.
You really have to contextualize this disparity within the hardware-centric defense contracting space, because it is the exact opposite of the software industry.
Oh, for sure. Software has almost zero overhead once it's built.
Exactly. In software, your cost of goods sold is virtually zero. You write the code once, and you can scale globally with the click of a button. Hardware, and specifically military-grade directed energy hardware, requires immense front-loaded CapEx.
Capital expenditure. So that initial $25 million is essentially just the cost of entry.
Right. You're not just building a quick prototype in a garage. You have to lease the physical facility. You have to construct specialized clean rooms.
Because even a microscopic speck of dust can completely ruin a high-power optic lens.
Exactly. It's incredibly sensitive, and you have to engineer stabilization platforms. You have to hire highly specialized photonics engineers before you can even attempt to ship a single unit. The economics here follow a very steep J-curve.
The classic valley of death for hardware startups.
Yes, the valley of death. There is a very high initial cash burn to build the foundation, and that's followed by a valley where revenue just kind of trickles in through proof of concept orders.
So those $850,000 and $250,000 figures we're seeing, those are exactly that.
Yes, proof of concept deployments. Look, In defense contracting, a government agency does not just order 1,000 untried laser systems on day one.
Right, they buy a small batch first.
They buy a small batch, and they test it vigorously in extreme field conditions. I mean, they actively try to break it.
Hmm.
And only after it passes those rigorous field tests do the multi-million-dollar, multi-year procurement contracts get awarded.
So the massive margin expansion happens on the back end of that J-curve once the production line is hot and the initial capex is largely paid down.
Exactly.
Which really explains why they aren't just trying to sell a standalone blue laser component. Because if you just sell the laser, you're a commodity, right?
Yep. You are easily replaceable by the next contractor who figures out how to make it slightly cheaper.
So to survive that J-curve and protect their future margins, Nuburu is aggressively acquiring the rest of the supply chain. I like to think of it as building a fortress versus just selling bricks.
That's a perfect analogy.
Sure.
And this is their vertical integration strategy. They've executed a binding letter of agreement to acquire a 70% stake in Tekne, which is a European defense contractor.
Right.
They've acquired Lyocon outright. And they have formed a joint venture with Maddox Defense.
It's like the Apple ecosystem approach.
Exactly like that.
If a company only sells you a microchip, you can easily switch to a competitor's chip tomorrow. But if they provide the hardware, the operating system, the specialized optics, and the manufacturing pipeline, which is exactly what Nuburu is assembling with Tekne, Lyocon, and Maddox, the switching costs become incredibly high.
They are building an integrated platform. And once a government agency integrates that platform into their broader defense architecture, it becomes deeply entrenched.
They become what the industry calls a sticky partner.
Stickiness is the ultimate moat in defense contracting. And what is really critical for our analysis today is that Wall Street is clearly beginning to recognize and price in this exact structural shift.
The market psychology is shifting.
Rapidly, the market is actively pricing in a reduction of execution risk based on these tangible M&A moves.
Yeah, and the internal market mechanics reflect that shift so clearly. I mean, we saw a massive fundamental breakout on the chart on March 20th, 2026.
We did. The shares traded significantly higher, basically in direct response to the announcement of that 70% stake agreement with Tekne.
And to be clear, this was not some retail-driven meme rally. This was the market reacting to real structural consolidation.
And the volume data completely corroborates the momentum. I mean, on March 18th, March 20th, and March 25th, the stock hit the most active and top movers lists across all these major trading platforms.
And when you see volume exploding like that on consecutive news days, it acts as a massive beacon for institutional algorithms.
Oh, the momentum algos love it.
They really do. Momentum-based buying algorithms are designed specifically to detect sudden velocity and new sentiment coupled with expanding trading volume. So when they detect it, they initiate buying programs, which just creates the self-fulfilling cycle of liquidity and price discovery.
Yeah, the broader market is actively re-rating this company. They're taking it from a tiny, dormant industrial supplier and repricing it as a legitimate, vertically integrated defense growth story.
But, smart wealth building is not just about identifying momentum. It is about relentlessly scrutinizing the bear case.
Always. A metamorphosis of this magnitude inherently carries some severe friction points.
Definitely. So we have to map out the exact risks and the catalyst dates that will basically determine if this company scales or stalls.
Okay, so the most glaring friction point here is operational scale. Look, before this recent flurry of acquisitions, aggregate data cited Nuburu as having roughly 14 employees.
14? Wow.
Yeah. And now they're attempting to integrate multiple entities simultaneously. I mean, they're bringing in Tekne from Europe, integrating Lyocon, managing a joint venture with Maddox Defense.
Scaling the corporate culture and operational logistics from a dozen people in a room to a multinational defense conglomerate. I mean, historically, that is exactly where many microcaps fail.
The operational strain of rapid M&A is immense. Now, the primary mitigation we can observe, the data point that suggests they might actually handle this integration, is the successful activation of their Phase I manufacturing facility in Houston.
Right. The fact that they successfully spun up a production line and hit that February manufacturing ramp for the 40 high-power systems, that proves they have baseline execution capabilities.
Yes. And Houston is a strategic hub for advanced manufacturing, so it provides access to the necessary specialized labor and supply chain logistics.
Right.
But, the integration of the European assets remains a very complex headwind.
Which leads us directly into the geopolitical risk of cross-border defense M&A. Let's really dig into the European expansion for a minute.
Okay.
In April 2026, They are expected to submit a golden power filing to the Italian government regarding the Tekne acquisition.
Right. And for those unfamiliar, the Golden Power Law is basically a mechanism that allows the Italian government to intervene in corporate transactions involving strategic sectors.
It is essentially Italy's national security veto.
Exactly. Because defense technology is not just a commercial enterprise. It is a matter of state sovereignty. European nations use these laws all the time to prevent critical defense IP from leaving the continent or, falling under the control of foreign entities that might not align with their strategic interests.
So let's explore the worst-case scenario here. Let's say the Italian government invokes the Golden Power Law and blocks this transaction outright, or they mandate conditions that make the economics of the deal totally unviable. Does this entire vertically integrated thesis just unravel?
It's a massive question. I mean, it is a critical vulnerability. If the Golden Power filing is rejected outright, the European integration thesis takes a significant and perhaps fatal blow.
That's a huge risk.
It is. However, looking at the structural context of how these deals are negotiated offers some reassurance here. The data indicates that this filing is actually part of a restoration of the Tekne acquisition framework, specifically following prior discussions with the Italian government.
Ah, okay.
Yeah, in the realm of international defense M&A, a company rarely progresses to a formal, restructured Golden Power filing unless the back-channel diplomatic and regulatory assurances have already been roughly negotiated.
Right. They wouldn't waste the time and legal fees if it was a guaranteed no.
Exactly. It suggests management is actively navigating the regulatory friction. But of course, the risk remains until the ink is completely dry.
And while they are navigating international law, they also have to manage, frankly, the most common threat to retail investors in the microcap space, which is dilution risk.
Oh, yeah.
That $25 million financing from YA2PN was structured as an unsecured debenture with warrants. Let's break down exactly how that impacts you, the listener, if you're holding shares.
Right, because a warrant gives the holder the right to purchase newly issued shares of stock at a specific predetermined price in the future.
Which means if the company executes perfectly and the valuation explodes upward, YATPN is going to exercise those warrants.
Without a doubt.
And when they exercise those warrants, new shares are essentially created out of thin air and added to the total pool of stock. The overall pie gets bigger, which means the slice of the pie owned by existing shareholders gets smaller.
That is the textbook definition of dilution. The value of your individual shares is diluted by that newly created supply.
It is the ultimate double-edged sword of microcap investing.
It really is. Because the capital is absolutely necessary to survive the J-curve we discussed earlier, but it comes at the potential cost of future equity. And the only way a company outruns the dilutive gravity of those warrants is through sheer, unrelenting revenue growth.
Right. Revenue growth has to vastly outpace the creation of those new shares.
Correct. And this is exactly where the speculative chatter in the market right now becomes highly relevant. There are persistent market rumors regarding a multi-program expansion following that initial $250,000 Lyocon order.
Interesting.
If that proof of concept deployment rapidly scales into a multi-million-dollar follow-on procurement contract, the top-line revenue growth will be more than sufficient to absorb the dilutive effects of the warrants.
But it requires flawless commercial execution.
Flawless, yes.
Which really brings us to the most important dates for you to circle on your calendar. Aside from that Golden Power filing in April, the second quarter of 2026 is basically the absolute crucible for this thesis.
Q2 is huge. That is the window where we expect the delivery and the potential revenue recognition for both the $850,000 production ramp and the Lyocon Dazzler order.
Because revenue recognition is the ultimate de-risking event. We need to see the transition from flashy press release announcements to actual cash hitting the income statement.
Exactly. Real dollars.
So when we synthesize all of this, the pivot from industrial welding to counter-drone tech, the $25 million lifeline, the vertical integration spanning from Texas to Italy, and those very real risks of operational scale and shared dilution, how do we evaluate this landscape?
Well, taking all the data into account and really balancing the tangible M&A execution against the inherent microcap risks, this presents as an 8 out of 10 bullish investment thesis.
8 out of 10, okay.
Yeah. And the defining characteristic here is the aggressively condensed 6 to 12-month target horizon. We are not waiting years for a prototype to be built. We're tracking the real-time re-rating of a company transitioning from a sub-$10 million market cap to a vertically integrated defense entity.
They are essentially attempting to skip several steps on the evolutionary ladder.
They are. The successful proof of concept for the counter-UAV platform in a $20 billion market proves that the underlying physics actually work in the field.
And the fresh capital provides that necessary operational runway to survive the manufacturing J-curve.
Right. And the integration of Tekne, Lyocon, and Maddox Defense provides the economic moat. So as an investor, your primary mandate here is to closely monitor the successful closing of the Tekne acquisition through that Italian regulatory process and track the Q2 revenue recognition.
Because those are the explicit mechanical triggers for the next phase of valuation expansion.
Precisely.
It's honestly a fascinating case study in corporate adaptation. I mean, they looked at a broken macroeconomic equation, expensive missiles, shooting down cheap drones, and they applied their proprietary physics to solve it. But before we wrap up today's analysis, let's step outside the military scope for a moment and consider the broader implications of this technology.
Okay.
If a relatively inexpensive, portable blue laser dazzler successfully proves it can reliably blind and disable an incoming drone threat in a combat zone, where else will this be deployed?
Oh, that's a massive question.
Right, like could we be looking at a near future where directed energy non-kinetic tools become standard issue safety equipment for every single commercial shipping vessel navigating contested global trade routes?
Wow.
Will portable laser dazzlers become like mandatory structural fixtures on domestic oil rigs, nuclear power plants, and critical infrastructure sites worldwide? The defensive capabilities of light itself are just beginning to be unlocked, and the commercial applications here might honestly dwarf the military ones.
It's a profound shift. I mean, it changes how we approach physical security on a global scale.
It really is something to carefully consider as you watch this sector evolve over the next 12 months. Thank you for joining us for today's discussion, and we look forward to unpacking the next major market catalyst with you tomorrow. Keep learning, keep analyzing, and take care.